Hello again. We're now on Chapter 24 of the final exam review, the last one, Capital Investments Analysis. And in the summary review document, the three main points here are to understand the calculations and determining the best alternative for major capital expenditures using the cash payback, the internal rate of return, or net present value methods. Understand why the net present value and internal rate of return are superior to the cash payback method in analyzing potential capital investments and why that is. And basically it's because they consider the time value of money. The cash payback period does not. And as you can see from the interest rates, the rate of return that most companies wish to get on their projects, that really makes a big difference regarding the present value of the dollars that are involved. So with that, we will look at problem 24-1A, just parts A and B that give us an illustration of a cash payback and net present value projects. So first of all, they're asking us to compute the cash payback period on 3 different projects. I'm going to go through 2 of them, and if you wish, you can go through the last one, and if you want to even turn it in for possible extra credit, I'll certainly consider that. Or if you just want to talk about it on the discussion board to see how you did, that's fine too. But in any case, we have the 3 projects. There are some assumptions given that the company uses a 15% desired rate of return. They use straight line depreciation. And what we are given in terms of an amount per year that they're earning, that they expect to earn on the project is given as net income. And the reason that's important is that they also told you that they're using straight line depreciation. They give you an overall project cost. And so when we look at this for this first project, Kilo, we have to take, and this involves the same projected net income years 1 through 5. So that makes things a little bit easier, because we can simply take the cost of the project divided by the annual anticipated cash flow, net cash flow. But in order to get that net cash flow in this situation, since we were given a net income of $14,000, we have to add back the anticipated depreciation, because that's a non-cash expense. So when we do that, here the annual depreciation is simply $150,000 divided by 5 years of useful life that's estimated, and we need to add that back to the net income to get the actual cash flow per year. So it's really $150,000 divided by 44,000, which again is the sum of the net income plus the depreciation expense added back. And when we go through that calculation, we get 3.41 years, 150,000 divided by 44,000. So that's our cash payback period, 3.41 years for Project Kilo. Now we move down to Lima, and this gets a little more complicated, because now we have a different cash flow amount per year. We have a project that cost $165,000, so the annual depreciation that again we need to add back, because they gave us net income for each year, is $33,000 based on 165 divided by 5. So our actual cash flow anticipated per year is the sum of that net income plus the $33,000 depreciation. So it's $51,000 for year 1, $50,000 for year 2, based on 17 plus 33, year 3, $49,000, 16 plus 33, and so on down the line. And notice how the net income per year is dropping off as we get further into the project. So that's going to impact on our cash payback period. It would also impact on our net present value analysis coming up. So when we do the cash payback period, when we have uneven cash flows, we need to look at the cumulative cash flow and compare that as we go to the cost of the asset. We know the cost is $165,000 as we go through each year here of cumulative cash flow. By year 3, we've accumulated $150,000. Well, it's not quite enough to cover it. In year 4, we're going to have $45,000 as shown of cash flow. It's going to take us $15,000 more based on the fact that we've accumulated $150,000 up till now of payback, and $15,000 more is 1/3 of the total amount we're going to accumulate in cash flow for year 4. So knowing that, our cash payback period then will be 3.33 years. We got 3 full years to get $150,000 in cash flow, 1/3 of the following year, year 4, to get the remaining $15,000 based on a cash flow of $45,000 in year 4. So hopefully everybody's with it on that. So that is the cash payback period for those 2 projects. Again, I'd encourage you to go through and look at Project Oscar and do the same thing for that. That also involves uneven cash flows per year. Now we move on to the net present value. And here, of course, again, we need to know what the interest rate is that the company is using. And again, we need to know also the information about cash flows per year. And of course, we need to know what the discount factor is to use in order to compute the present value of the cash flows. Now in Project Kilo, it's pretty simple. We know it's $44,000 per year, 5 years worth of that. And for the exam, any discount factors that you need are going to be provided. The only proviso to that, or caution, is that I won't necessarily give you just the factor that you need. You may need to choose between, say, a factor to use per year for these uneven cash flows and an overall present value of an annuity, which this one for Project Kilo is. Because when you have even cash flows per year, you can simply use the discount factor found in the table that's called present value of an annuity of 1. In this case, the discount factor, I apologize for making that as small as it was, but it's 3.35216. Okay, that's what I'm multiplying the 44,000 by to get 147,495 as the net present value of the cash flows. Now remember, we're not done yet, because we need to compare that to the project cost, or the cost of the new asset, which is $150,000. And so when we subtract that asset cost from the net present value of the cash flows, we get a net present value of the project of a negative 2505, and that's not good. That's going to indicate that we should not invest in this asset. Okay? So that's Project Kilo, which again is pretty straightforward, same cash flow per year. When we go to Project Lima, that has a different cash flow per year, we can simply drop that cash flow information from the cash payback part of it into years 1 through 5 for Project Lima on this one. But now, in doing net present value, we need to multiply each of those annual cash flows by a different discount factor per year. And again, these would be available in a table called the present value of 1. And so these will be given to you on the exam. It's just a matter of plugging them in the right place and doing the math properly, and you should be fine. And notice how the discount factors decrease over time. In year 1, we're looking at, again, I apologize for my small writing, just trying to get the whole thing on the one board here. 86957 is the discount factor for year 1, and by the time we get to year 5, it's down to 0.49718. When we multiply those discount factors times the annual cash flows, which again are different every year in this case, and we get a present value of the cash flows. So for example, we we get 44,348 in year one based on that 86,987 times 51,000 of cash flow, and so on down the line. So notice again that not only is the cash flow itself decreasing per year, but when we multiply it times this decreasing per year discount factor, because of time value of money, the further out you have to go to get your money, the less it's worth today, right? So we're down from a present value of 44,348 in year one in this final column here, all the way down to 20,882 in year five, even though we have a total cash flow still of gross of 42,000. And notice too the difference between the sum of the cash flows not adjusted for present value is 237,000. Well, when we adjust it for present value, it's only 160,984. And when we compare that, again, that's just the net present value of the cash flows. We're not through yet. We have to compare that to the project cost of 165,000. And again, like it did with Project Kilo, it compares unfavorably. We have a minus 4,016 shown on the very bottom here as the net present value of the project, based on, again, on the 165 project cost minus the 160,984 net present value of the cash flows. Again, the discount factors, if you get a net present value problem, will be provided to you. It's just a matter of you're using them properly and making the proper calculations. Okay, that's it for chapter 24.